Abhiram Eleswarapu, Head of India Equity at BNP Paribas India. Abhiram, thanks very much for joining in. I was reading some of your recent comments, and it seemed like in one of the interviews you did mention that despite all the volatility and the concerns that we saw after the fourth quarter, you still fancy IT services. Now, today we are at such an instance once again when there's a global IT company which has cut its guidance, and there's a lot of concern playing out here in India. We're seeing that on stock prices today. Do you retain the view? Do you think that all these dips, like the one that we're seeing today, are they a buying opportunity for you?
Well, I was expecting this question, to be honest. The view has not changed from a big picture perspective. Bear in mind that when we do take these calls, we are taking 12 to 24 months out view. Now, there's no denying the fact that the near term could be difficult. I mean, we are indeed facing a recessionary environment in the US. I mean, if you look at our own forecast, we are calling for quarter-on-quarter GDP declines in the third and fourth quarter in the US. So that the fact that demand could be impacted is somewhat known. Is it going to be much worse than we know? Well, maybe not, because at the end of the day, the peer company, the global peer that did announce an outlook today also is not a direct comparable to the Indian peers. I mean, it does have big operations in places like the Ukraine and so on and so forth, which Indian companies do not. So it's not like for like. Now, having said that, we do have a deal tracker which looks at how deal flows are shaping up across the world. What is emerging is that Europe is still looking quite good in terms of deal flows. What is going to be a little bit of a concern is actually North America, where we haven't really seen a whole lot of new deals announced in the past month or so. Broadly, I would say that the deal flow is okay. It's about revenue conversion, which looks a little tricky. And so maybe one more quarter of weakness, and I think thereon the longer-term story still plays out.
Abhiram, just wanted to understand, have you had a chat with any of the IT companies in the last 2 months since they came out with the Q4 numbers? What's been the feedback? Has the situation deteriorated or remained just the same? And is there a risk that FY24 guidance may not be met? So just wanted to get the feedback that you've got from the companies over the last 1 month.
Well, over the past month or two, the feedback has almost all entirely been about deal flows. Now, as you know very well, that companies don't really change their revenue outlook, every month. But in terms of deals, everyone's been still quite confident, including on the pipelines. I think what companies are struggling to comment upon is how much of that pipeline converts to deal wins and how much of those deal wins convert into revenue. So those remain the kind of tricky points for analysts to come to terms with. Now, in terms of the guidance, as you would have seen at the start of the year itself, companies brought down their numbers, to mid-single digits, maybe slightly higher than that. So by and large, even if there is a cut to that, I would expect that it would be marginal from here on. And maybe stocks to some extent would have priced that in. Of course, when the cut indeed comes, then stocks will react. But I would say a large bit of that is probably already in the price.
Somebody was half jokingly, I read it somewhere, I don't remember where. What if we already saw the recession in the US. I mean, it's already behind us, not ahead of us. We remember you got that 2 quarters of dip, right? I think it was last year. So what if the recession everybody is fearing is behind and not in front? Now that's food for thought. Abhiram, what are you doing though in terms of sectoral preferences? Anything new companies you've initiated on? Because this is a market for single stocks and such big, massive rallies on practically no news. P multiples have gone up quite a bit. I'm talking about the 101 to 300 companies by market cap. I mean, forget the first 100. That's where bulk of the action has been.
Yeah, no, I don't deny that at all. In fact, let's take a step back to take the big picture perspective. I would think that by the end of the year, and we still retain the view that you'll probably have mid-single digit returns from here on for the large indices, for example, the Nifty. So clearly, like you mentioned, the action is not going to be there. It's going to be much more likely, within sectors and not just sectoral, but even within sectors, you could see a wide dispersion of performance. So what we're looking at for one is financials, which I've mentioned before. I think what's incremental on financials now is that deposit growth has started to pick up. That used to be a bit of a concern until a month or two when we felt that credit growth is good, but what's going to fund that or fuel that? So that answer has come out in the last month or so. So financial still remains the space. I mean, I mentioned before, insurance is one of our big areas of investment as well, not to mention NBFC. So financials as a whole, number one. Number two, autos. We still like, I do agree that many stocks are at 52-week high and so on, but we still like the four-wheeler space quite a bit. In terms of two-wheelers, of course, there's an EV threat coming up, but I think what's more near-term also is the fact that we see whether this demand holds up past the festive season. We have our own doubts around that. So for those two reasons, I would say four-wheelers better than two-wheelers. And looking beyond that, though, I would say everything becomes extremely stock specific. For example, in healthcare, we do like some companies. For example, the specialty chemicals, we do like some areas of diagnostics, which I think have fallen quite a bit. Within consumer durables, again, a few names here and there. So I think from there on, it becomes extremely stock specific.
Abhiram, what about the Nifty? We are holding above that 18,500 odd mark. I think the last time you chatted, you said 19,500 could very well be on the cards. That's not too far away. By when do you think we get there?
No, good point. I think 19,250 is our target, so we're less than 5% away. Now, what tends to happen under such situations is that the market it's not like it'll move in a straight line with just 3 or 4% return to the end of the year. What I do suspect is that there could be some volatility both up and down, and we eventually end up marginally higher than where we are today. And why I say that is because in the second half, there are a few things to look forward to. I mean, I would say the narrative could revolve around, number one, are we done with rate hikes in the US? And our house view is that while there could be a pause in June, you could very well have a hike in July. So that's number one. Number two is you're getting mixed signals from the US, especially where employment numbers are really good, but you may have seen the ISM services data that came out last night was not. So mixed kind of feedback from there, but it does suggest that there's very much a slowdown that's building up in the US. And last but not least, now that you've had the debt ceiling resolution, whether there'll be a case for fund managers to move away from equities, probably have much more supply on the treasury side, and whether that would impact flows into emerging markets. Now, bear in mind that of all the emerging markets that at least our team looks at, I mean, India looks like the clearest story of all. I mean, to build a 3 to 5 year view, it's really hard to look beyond India at this point. But if emerging markets as a whole have some amount of outflows, then it is very much possible that India would face some of that as well. So in short, you'll have moves both up and down, but you'll end up slightly higher than where you are today.
Abhiram, thank you very much for joining in. Need to get into a break. On the other side, we'll get you a check